The dollar index just hit the 98th percentile. And dollar strength at this level puts pressure on emerging markets and commodities. Something is breaking beneath the surface, and the data confirms it. Right now, the dollar index is at 101.2, the 98th percentile for the past year. Historically, dollar strength at this level puts pressure on emerging markets and commodities. Snider says, the eurodollar system is tightening and nobody sees it. The data says gold rose 0.9% today, moving against the bearish consensus. In the next few minutes, I will show you who the data says is right and what it means for your money this week. The scoreboard just changed. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. The volatility expert just moved from wrong to right. The volatility expert is right, and the data keeps proving it. VIX at 18.6. McElroy might be right, but the data has not confirmed the thesis yet. 187-day streak, Hartman might be right, but the data has not confirmed the thesis yet. 181-day streak, the commodity analyst call is not working, for now. Oil falling to $69.5, down 3.4%, opposite of the bullish call. 4 days running, Gammon just moved from right to wrong. Gammon is wrong, for now. Investment grade spread at 75 basis points is moving against the thesis. Snider just moved from right to wrong. Bad stretch for Snider, for now. For now. Yield curve at 0.31% says the opposite of dollar liquidity crisis. The dollar analyst just moved from right to wrong. The dollar analyst call is not working, for now. Gold moving against the bearish thesis, up 0.9%. Score today, 1 right, 2 early, 4 wrong. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. Today's big question, is the dollar about to surge or is it topping out? Snider says the eurodollar system is tightening and nobody sees it. That is the thesis driving the debate today. It sounds right on the podcast and it is a clean narrative. But here is the problem. Gold rose 0.9% today, moving against the bearish consensus. If the data is right and the speaker is wrong, positioning changes fast. Here is what makes this interesting. The dollar index is falling while gold is rising. Those two signals should not be going in opposite directions. When they diverge like this, one of them is lying, and the resolution is usually fast. The dollar index at 101.2, 98th percentile, down 0.2% today. Gold at $4,065, 36th percentile, up 0.9% today. Bitcoin at about $59,000, down 0.8% today. Bottom line, right now Snider has the better case. The dollar index at the 98th percentile backs the thesis, even as other signals push back. If the dollar index breaks below 99, the milkshake theory loses its legs. Right now, it is at 101.2. If gold and Bitcoin both rally while the dollar holds, the liquidity thesis is wrong. The dollar index at 101.2 is in the 98th percentile, reversal territory. If it drops below the 75th, the thesis weakens fast. Gold at $4,065 will track it daily on the scoreboard. None of the 7 are talking about this next signal, and they should be. 10-year yield just dropped 2% to 4.41%. A move this size demands attention. Historically, the 10-year at this level reprices every leveraged asset in the economy. None of the 7 are talking about this. Keep it on your radar. Phase 1 is the good times, but good times do not last forever. Here is how close we are to the edge. We are 75 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment grade spread crossing 150 basis points, currently at 75 basis points. At this week's pace, that is roughly 75 weeks of runway. That is mid-December. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has CFNAI, equity risk premium, flashing red. Gammon says, the Fed is breaking things and credit spreads will blow out. The data disagrees with that thesis right now. Phase 1 holds with 75 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the ZIP level data is screaming about today. Owsley, KY, lenders are saying no, at scale. In Owsley, KY, the HMDA denial rate is 86% across 50 applications. Top reason, credit history. Credit doors closing is the slowest, surest signal of a turn. Jefferson, MS, lenders are saying no at scale. In Jefferson, MS, the HMDA denial rate is 77.5% across 142 applications. Top reason, credit history. Credit doors closing is the slowest, surest signal of a turn. VA, days on market is collapsing in Virginia Beach. Days on market in Virginia Beach moved 100% in 30 days, now 8 days. Buyer leverage score, 47/100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, is the dollar about to surge, or is it topping out? Let me show you what happened the last time we were here. The dollar index at 101.2 is in the 98th percentile. That means it is higher than 98 out of 100 days in the past year. In 2022, dollar index hit 114, crushing emerging market currencies and commodities. In 2020, dollar spiked during the March liquidity crisis, then reversed on Fed intervention. In 2015, dollar strength crushed commodity exporters and triggered EM currency crises. Different environments, different catalysts, but every time the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, gold at $4,065 is in the 36th percentile. The last time both the dollar index and gold were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. If history rhymes, Snider should be paying close attention because the clock is ticking on this pattern. Here's what the data says to do right now. Stay alert on VIX. It is dropping 4.4% today. Fast moves demand attention. Avoid Phoenix at 41% payment burden. That is stretched territory. Watch 10-year yield. It dropped 2% and nobody's talking about it. Only one speaker is right this week. Low conviction environment. Size positions smaller. Every signal is live at analyze.builderslens.com. The talking heads give you opinions.com. We give you the numbers. Subscribe, and I will see you tomorrow morning with a fresh scoreboard.